In September 2000, inside a towering glass skyscraper in Dallas, Texas, a meeting took place that would fundamentally rewrite the future of global entertainment. Reed Hastings, the co-founder of a fledgling company bleeding cash, sat across from John Antioco, the powerful chief executive of an undisputed retail empire. Hastings had arrived with a desperate proposition, offering to sell his entire operation for $50 million. The retail giant, Blockbuster, was at the absolute zenith of its market dominance, and Antioco reportedly struggled to suppress a laugh at the audacity of the pitch. At that moment, Netflix was barely surviving the turbulent headwinds of the early dot-com collapse. Their DVD by mail operational model, relying heavily on the United States Postal Service to deliver physical media, was hemorrhaging capital at an alarming rate. Hastings and his team were desperate for a lifeline, hoping to rebrand their service as the digital arm of the established retail titan. They sought the safety of corporate backing to offset their devastating logistical costs, viewing the Dallas summit as their last viable exit strategy before total insolvency. Blockbuster, conversely, possessed a colossal footprint that seemed entirely unassailable to both Wall Street and Main Street. With thousands of physical storefronts anchoring suburban strip malls across the globe, the company commanded billions in annual revenue. Their business model was exceptionally lucrative, heavily subsidized by a controversial but highly profitable mechanism: late fees. Millions of customers routinely paid penalties for returning VHS tapes and DVDs past their due dates, effectively generating a massive, high-margin revenue stream that required zero additional product investment from the corporation. The decision to reject that $50 million offer became a defining corporate misstep, ranking among the most catastrophic mistakes in modern business history. Forced to retreat to California without a deal, the struggling founders had to execute severe operational cuts just to keep the lights on. Yet, the rejection catalyzed a ruthless survival instinct within the startup. Without the safety net of an acquisition, they were forced to ruthlessly refine their logistics and consumer offering, transforming their desperation into a highly optimized distribution network. The bruised upstart quickly abandoned single rental fees in favor of a flat monthly subscription, entirely eliminating the punitive late fees that its massive rival relied upon. This strategic pivot aligned perfectly with consumer psychology, offering predictable costs and unlimited retention of the media. Furthermore, they began deploying sophisticated algorithms to track viewer preferences, effectively turning their inventory management system into a personalized recommendation engine that maximized the circulation of less popular, lower-cost catalog titles. While the subscription model flourished, the retail giant's reliance on penalty revenue created a fatal structural vulnerability. Blockbuster's executives recognized that eliminating late fees would instantly vaporize hundreds of millions of dollars from their balance sheet, a prospect that terrified their shareholders. This financial addiction paralyzed their ability to adapt, trapping them in a legacy model that actively punished their most frequent customers. The very mechanism that had fueled their historic profitability now served as the anchor dragging them toward obsolescence. Simultaneously, a profound shift in global infrastructure was quietly eroding the necessity of physical storefronts. The rapid expansion of residential broadband internet began conditioning consumers to expect immediate, frictionless access to information and entertainment. The Friday night ritual of driving to a brightly lit retail store, wandering through aisles of plastic cases, and hoping a new release remained in stock was rapidly losing its appeal. Convenience was becoming the ultimate currency in consumer markets, and physical distance was suddenly a massive liability. Belatedly recognizing the existential threat, Antioco eventually launched a massive counteroffensive known as Blockbuster Total Access. This hybrid initiative allowed customers to rent movies online and exchange them in physical stores, a massive logistical undertaking designed to leverage their vast real estate portfolio against the rising digital tide. The program was highly effective at capturing market share and temporarily stalled the upstart's growth, proving that the legacy brand still possessed formidable market gravity when properly mobilized. However, this aggressive counter-strategy came at an excruciating financial cost, subsidizing both a massive physical footprint and a complex postal distribution network simultaneously burned through corporate cash reserves at an unsustainable pace. Activist investor Carl Icahn, horrified by the collapsing profit margins, launched a hostile boardroom campaign against Antioco. The ensuing proxy war prioritized immediate quarterly returns over long-term strategic survival, ultimately forcing out the only executive who had successfully managed to slow the shifting tide of the industry. With the retail giant consumed by internal leadership battles and massive debt obligations, the window for true innovation permanently closed. The legacy corporation reverted to its traditional retail strategies just as the underlying technology of the Internet crossed a critical threshold. The era of physical media distribution, whether by mail or by storefront, was about to be completely eclipsed by the instantaneous transmission of data. The battleground was no longer physical logistics, it was bandwidth. In 2007, the surviving startup executed the maneuver that would cement its ultimate victory, the launch of its video-on-demand service. This streaming revolution bypassed the physical supply chain entirely, delivering content directly to personal computers and, soon after, internet-connected televisions. By eliminating postage, packaging, and physical inventory constraints, the company drastically altered its margin structure. It transformed from a logistics operation into a pure digital platform, capable of scaling globally without building a single warehouse. The consequences of this digital migration rippled devastatingly through local economies. As foot traffic plummeted, the iconic blue and yellow storefronts that had anchored communities for decades began to shutter en masse. Thousands of retail workers, store managers, and regional directors found themselves abruptly unemployed as the corporate entity collapsed under the weight of its massive real estate leases. The localized social experience of renting a movie was systematically dismantled by the quiet efficiency of the server farm. By September 2010, exactly 1 decade after laughing off the $50 million acquisition proposal, Blockbuster formally filed for bankruptcy protection. The sprawling empire, crippled by nearly $1 billion in debt, was unceremoniously auctioned off for parts. Its intellectual property and remaining assets were absorbed by a satellite television provider, marking the definitive, humiliating end of a brand that had once dictated the terms of global home entertainment. Meanwhile, the victor of this brutal market transition refused to rest on its technological advantage. Recognizing that content creators could eventually build their own digital distribution platforms, the company began investing billions in proprietary productions. By funding original series and exclusive films, they aggressively transitioned from a mere distributor into an elite Hollywood studio. This vertical integration ensured they would never be held hostage by the licensing demands of legacy media conglomerates. This relentless expansion fundamentally rewired the global cultural apparatus. The concept of appointment television, dictated by rigid broadcast schedules, was entirely replaced by the binge-watching phenomenon. Entire seasons of high-budget narratives were released simultaneously, catering to an audience that now demanded total control over their consumption habits. The streaming model crossed international borders with unprecedented speed, creating a unified, globalized cultural conversation driven by algorithms and instantaneous access. The financial divergence between the two entities stands as one of the most stark contrasts in modern economic history. The company that was once dismissed in a Dallas boardroom eventually achieved a market capitalization exceeding $200 billion. It attracted hundreds of millions of paying subscribers across nearly every country on Earth, generating vast, recurring revenue streams that dwarfed the peak earnings of the retail giant it had vanquished. The rejected offer had become the most expensive missed opportunity of the 21st century. The untold story of this downfall and subsequent rise is not merely a tale of technological obsolescence. It is a profound lesson in corporate psychology, illustrating how the very mechanisms that create a dominant empire can blind its leaders to impending disruption. Blockbuster was fatally anchored to its historical success, unable to cannibalize its own profits to secure its future. Netflix survived because it possessed nothing to lose, proving that true market dominance belongs not to the massive, but to the relentlessly adaptable.